What's going on, everybody? Welcome back to another video here. It feels like it's been forever since I've recorded one of these long form videos for you guys, and it kind of has been. Those of you guys that have been following me on Instagram and TikTok, you guys have seen a boatload of me over the last few months here, but I really want to start making some of these long form videos. Again, remember, I told you guys in the public live stream this morning that we have a lot of cool videos coming, and this is the first one. Now, we have been talking about this TLT situation or the potential TLT trade for about 2 years. Now, we've made 2 videos about this on the past. We've been pretty spot on with our analysis throughout the entirety of covering basically government bond yields over this 1.5 to 2 year period. And we're starting to see a lot more things develop. We have a very, very key thing going on with the reverse repo. And we also have, I believe it's $7.6 or $7.4 trillion of United States government debt that needs to get refinanced next year, which, if you guys know anything about refinancing, well, do you really want to refinance at higher rates or lower rates? So we have a lot to cover in this video, guys. And again, this stuff is relatively complex, and I'm going to do my best here to break this down as simply as possible. So if you guys have any questions, or if you feel that I haven't explained everything properly and you still have some questions, just drop a comment down below and I will get back to all of your questions. As always, if you wouldn't mind hitting that like button and subscribing for more videos like this. But let's get right into it here. So looking at TLT on the daily time frame, just a little bit of a background here on what I've been doing with this trade in the meantime. So if you were following along on Twitter and you saw a lot of people talking about government bond yields and TLT, a lot of people were getting interested in purchasing either shares or options on TLT below 100. I disagreed with this. I thought that there was a lot more room lower on TLT and higher in terms of bond yields, specifically the 10-year Treasury yield hitting 5%, which is right around where it topped out at. Now, the level that I was really looking for to start my TLT purchases was sub 85. If you look at that on this chart, it's right down in here. Now, the other thing that I want to just briefly touch upon before we move forward is that there are a lot of large money institutional players that are looking at the exact same things as we are. One of those being Bill Ackman. Now, Bill Ackman had a very, very similar thesis to what I did, that yields were set to go higher. And that's where we saw this big move to the downside. And as you guys can see over here, Bill Ackman's bet against the against United States Treasuries pays off with about $200 million of profit. Not too bad. Now, recently, it does appear that he's actually looking for rates to come back down, so he could actually be long treasuries right now, but there's really no way to actually be certain about this. Now, the next thing that I want to really cover here, guys, is the concept of TINA versus TIA. So TINA, if you guys remember, was the concept of there is no alternative, meaning there is no alternative or adequate alternative to investing in the stock market where you could get some very substantial returns. Now, again, that is going to come with a little bit more risk, but looking at, let's actually pull up the 10-year Treasury yields on a monthly time frame so that you guys can get a better understanding of this. Well, ever since basically the 1980s here, we've seen a very, very clear and significant downtrend in these 10-year Treasury yields. You guys can see this right here from back in the 80s all the way back down. Now, if you were an investor back in, let's say, 1991, 1989, you could get, let's say, an 8% yield on these 10-year Treasuries. So that 60-40 equity bond portfolio, where 60% would be placed in stocks, 40% would be placed in bonds, actually looked relatively good. But these days, it doesn't necessarily look as if that's the case. And that is where TINA came from. There is no alternative. Now, these days, you have to think about this in terms of a relative scale and how much more risk there is out there in the market at any given time. There's so much more money floating around. There's a lot more derivative usage. So investors who are yield hungry or looking for some of these quote unquote risk-free rates of return could then turn to the United States Treasury market and lock in some of these higher yields here, which is exactly what it looks like some of them are starting to do right now. Now, going further on this concept of, let me refresh this page here, of TIA versus TINA, is the 60-40 dead, which is basically that TINA concept that we were talking about. Now, as you come down here a little bit further, they refer to the lost decade between 2000 and 2009, in which nominal returns, which again, let's say that you have a stock portfolio that goes up 10% in a year. The nominal return would be 10%, the actual return that you saw. But the real return, they're adjusted for inflation or any other factors here, was actually a lot lower. So you were not beating inflation, even though your portfolio was increasing in value. Now, what people might point to over here is this last decade between 2011 and 2021 and say, well, the 60/40 bond portfolio actually performed pretty well. Yeah, it did, but if you look at what the overall market did during that time, we pull up the SPY here on the monthly time frame and we go back to 2011. Let's go all the way back here. The SPY, the S&P 500 ETF, was trading at about $125, and currently these days it's trading at $456. So a lot of those gains were coming from the 60% of those portfolios that were in the equity market. Because again, if these bond yields are coming down, again, you could see some of these bond values go up as well, which again is going to contribute to some of those gains, but not as much as what a almost triple or quadruple in just an index here, or an ETF in this case, is going to do for your portfolio. Now, I want to talk a little bit more about rates, what the Fed is doing, and just the overall situation that we are in right now, because everything is starting to go according to plan. Even today, and we're going to talk about this a little bit more, Janet Yellen said that it's problematic effectively to have rates this high going into 2024, and that's going to feed into this debt refinancing situation, which we're going to talk about in a little bit as well. But when you think about where we are in this rate hike cycle, to me, it doesn't appear that the Fed needs to raise rates anymore. And actually, as we're going to take a look at too, the expectations for when the Federal Reserve is going to be decreasing interest rates is really starting to pick up for next March in what these basically large market participants are expecting. But the first thing is this right here. When we take a look at the unemployment rate right here on a 5-year time frame, you can see that it had this relatively massive spike here in 2020 during the pandemic, and it was relatively flat right around that 3.74% area. But what have we seen happen recently? We saw unemployment start to come down. It bottomed out at around 3.4% here, chopped around, and is now back up to that 3.9% area. Now, what does this tell us? Well, we're back to some of these sort of normal levels in terms of unemployment. But this Friday, we have non-farm payrolls coming out in which we are going to see an update on the United States unemployment rate. If that data comes out higher, what large money players are going to do is increase their bets and start to take positions sooner and more aggressively that the Fed is going to start cutting rates sooner. So there was that narrative of Jerome higher for longer Powell, and that rates were going to stay higher for longer until they could get to a sufficiently restrictive stance. Guys, I could sit here for 5 hours going through all of the different economic data points in every single piece of data that is going to point to whether we are or not at a sufficiently restrictive stance yet. But again, I think that's just a waste of everybody's time right now. So looking at what the reactions are to all of this data coming out, here is what we see. When we come over to March of 2024, for that Fed meeting, what is the probability that we decrease interest rates? Well, the current target rate right now set by the Federal Reserve is 525 to 550 basis points, or 5.25% to 5.5%. When you look at this number right here, you can see that 500 to 525 basis points has a 55.7% probability of occurring after the March meeting. That's a rate cut. Right now, they're pricing in a rate cut for March. Is it going to happen? That's anybody's guess right now. But seeing those probabilities start to pick up, well, large money institutional players are going to start taking positions, which again can be why you're seeing the yields starting to come down so much. Because, and I didn't mention this, but we did mention it in other videos here, is that if investors in general think that yields, government bond yields, are going to decrease in the future, well, they're more likely to buy those bonds now to lock in that higher interest rate. Very similar thing here. If a lot of these large money players are assuming that next year we're going to at least cut rates a few times, well, it makes more sense for them in terms of the portfolios that they're managing, if they want to have exposure to fixed income and government securities, to buy those bonds before the rates actually decrease so they're able to lock in a higher rate. Now, the government actually doesn't want this to happen, But when you think about what ends up happening is as there is more demand for these government securities, which are the treasury bonds or T-bills or whatever you want to call them, depending on the duration of the maturity, the demand pressure coming in increases the prices of these bonds, which ends up decreasing their yields. So as more people come into the bond market, yields go down, TLT benefits. So again, when rates go down in general, TLT benefits. So that's a very, very, very key point here. Now, this is where things get a little bit interesting. $7.6 trillion of United States government debt will mature in the next year, adding pressure on rates. This is adding a lot of uncertainty and a little bit of worry with a lot of people in the financial space right now, because they don't necessarily know where the government is going to go in terms of which duration or which maturities they're going to try and sell these bonds at right now. And again, this is what I said in the live stream this morning where I said something a little bit too complex, where they're leaning heavy on the short end of the yield curve. What that effectively means is that in order to meet the government's short-term obligations, they don't want to issue debt that they are going to be locking in a higher interest rate for a very extended period of time, like a 30-year. So what they're doing is they're selling a lot of these shorter-term bonds, the 2-year. Now, what happens when the demand is no longer there for those bonds? Well, they're going to have a little bit more trouble trying to raise all of this money. Now, if there's less demand, rates could go up. So again, this isn't a 100% certain trade, but I do expect that throughout the course of 2024, when we do see these cuts in rates, a lot more money that quote unquote has been on the sidelines will take a stab at the bond market. And that's exactly what we have already started to see. Now, guys, the other reason why this is important right here, this $7.6 trillion, is to think about what a government bond actually is. Let's say here, I go to the United States government and I say, I want to buy one of your bonds. They go, okay, here's the information about the bond. We're going to pay you this amount of interest, or if it's a zero coupon bond, whatever it is, let's just assume that it is an interest paying bond. Now, I give them money. They give me the bond certificate, basically saying that I'm entitled to those payments. Now, at the end of whatever term it's for, let's say it's 10 years, well, I've been collecting interest all this time, and then the government owes me my money back. So they owe $7.6 trillion back to whoever has bought these bonds. Where are they going to get that money from? It's not from taxes. It's definitely not going to be from what they have sitting there, because we're running at a very significant deficit right now. So they're going to have to sell more bonds in order to meet this obligation. Here's the interesting point here. When Janet Yellen comes out and says that having high rates going into the next year is problematic, this is what she's talking about. If rates are still this high going into next year when all of this debt needs to get refinanced, that's going to lead to some problems for the United States government. So what are they hinting at? Well, it's possible that even though this isn't necessarily supposed to happen, the government and the Treasury can start putting pressure on the Fed, depending really where we are at in this sufficiently restrictive cycle that we are in with these high rates that nobody has really seen, especially people my age have not seen rates this high. They could start putting pressure on the Fed and say, well, as soon as it is possible to decrease interest rates, start doing it. That is very, very, very key here, and something that we need to take a look at for the rest of basically all of this year and then 2024 as well. Now, here's where we get into something interesting here. Reverse repos. So a lot of people have been talking about reverse repos. There's a lot of misunderstandings around them, and I know a lot of you guys saw me on the live stream one day thinking about this kind of out loud, and I said, well, wouldn't that just add more cash back into the system anyway? We're getting a little bit ahead of ourselves here, but here's effectively what a reverse repo is. Well, when you see a boatload of money poured into the system, that was a weird noise. Right during the pandemic and all of that money printing, what happens to it? Well, some of it goes into the banking system, some of it goes into spending, but again, eventually a lot of that money is going to end up back in the banks. So then what happens? Well, the banks need to do something with that money. Now they're going to loan it out, but they need to make sure that they're able to meet some of their capital requirements and make sure that they're not overbuying treasuries. So maybe they have some internal requirements or internal regulations or some of the Fed mandated regulations that they cannot buy a certain amount of these longer duration or even medium term duration treasuries. So what do they do with all of that excess cash? Well, they enter into what is called a reverse repurchase agreement, in which the bank gives the Fed cash. The Fed gives the bank a bond and pays a very small amount of interest, and all of that transaction is then settled overnight and then reversed. But what you're seeing here, again, I know that could be a little bit confusing to everybody, so let's just make this super simple into what this chart is actually telling us. When you see this chart increasing and flatlining here, it is telling you that there is still a boatload of excess cash in the banking system because there is still a very high demand and a need for this reverse repurchase program that the Fed is offering. Now, when you start to see it coming down, what does that tell you? It means that there's no longer as much cash in the banking system. Now, when you think about that, it means that some of the effects of what the Fed is doing is working. It is withdrawing money out of the system. Now, when this number right here that you guys see right here, I believe this is what this number listed as 815. What's it in? I believe that's billion. Yeah, in billions of dollars here. So 815 billion. When this number goes to zero, which some people are expecting and forecasting that this could happen by early February, coming into March, kind of right around the time where people are expecting or starting to expect the Fed to start decreasing interest rates. Well, it's going to show you that there's no longer any crazy amount of excess cash in the system that they have to use this program here. It means that they can stay well within their mandates and their internal regulations or the Fed mandated regulations and go about their normal business activity. Now, what I will say is I don't necessarily think that when this number goes to zero here in terms of the reverse repurchase agreements, and again, this number is how much money is actually going to the Fed and then back from the Fed the next day. So I don't think that this by itself is going to be an indication of, oh, this goes to zero, rate cuts. But what I do think it does show us is a kind of push down the hill, if you will. If you had a giant ball or a wheel that you were about to push down the hill, this is the initial push in saying, hey guys, this money is no longer floating around in the system all willy-nilly. We could be looking at a situation over the next few months after that where the Fed could start decreasing interest rates. Now, the other thing that's going to be important to look out for, again, this is the reverse repurchase agreement when the banks are giving the Fed cash and the Fed is giving these banks these overnight bonds or overnight securities. If the repo market starts picking up, in which, again, it's the exact opposite, where the banks are then selling bonds to the Fed and the Fed is giving the banks cash, is almost like an injection of liquidity in a very short time frame. Well, that's definitely going to be something that's going to say, okay, we could be getting ready for some rate cuts here. So I know that was a lot of information, guys, and I threw a lot of this info at you here. But the main thing that I want you guys to take away is that, and think about, is that interest rate hiking environments and cutting environments and pausing environments, it's all cyclical. Eventually, interest rates will come down. It's just a matter of when and by how much. Now, there's a lot of different expectations out there as to where we could end up by the end of 2024. And let's just take a look at here what the CME group actually expects for this. December 24, where do they expect rates to be? Again, you can see the middle of this little bell curve here, that 30.8, there's a 30.8% probability that we are going to move down by about 1.25% here, or about 125 basis points, which again would be very significant, but it is not these drastic rate cutting environments that we were in back in 2020, which is why I've said before that I think that the TLT trade here is going to be a little bit slower. I don't think that you're going to see the same reaction here that you saw back in 2020 with this drastic move from 137 all the way up to this 179 area here. Now, again, we have seen this sell off significantly, so this definitely could get some legs under it. I mean, this is the monthly time frame here. I've established kind of the first bulk of my position. Once that reverse repo number starts to go to 0, I'll kind of look again and see where we are in terms of the pricing of TLT or TMF, which is the 3 times levered version of TLT here. But that's kind of my plan going forward here. Again, I believe that this situation is going to take a while to play out. Could be all of next year, could be all of next year and half of the next year, could be even the next 2 years. But when these opportunities present themselves, guys, you have to be ready and educated in order to take advantage of them. Now, if you guys are just like, yeah, I don't really want to mess around with bonds, but I'm interested in learning about this stuff, that's awesome too. Again, none of this is financial advice. I'm not telling you to go out and buy TLT. I'm not even buying it right now because my purchases were all about 10% ago, 12% ago, sub 85 here in that 83 range here. So again, these are just things to be aware of going forward. So again, guys, that's kind of going to wrap up this video here. If you did enjoy this, or you do enjoy these long form videos, make sure you guys comment down below, hit that like button. I like making these for you guys. I think we're going to have a lot of cool videos coming out in the near future. So yeah, that's going to wrap it up. Peace.